Hi, welcome to the channel. My name is Joseph Gutierrez, owner of MyLifeInsuranceBroker.net, and this is Covered in Compounding. So for today, we're going to be asking the age-old question. Should we consider term insurance or should we consider whole life insurance? Now, there's been no shortage of internet gurus out there that have voiced their opinion on the subject. Luckily for today, we're going to be cutting through all the noise, cutting through all the ignorance, and going over the best policy designs for your situation. Not only that, we're going to answer the two most common questions when it comes to putting a policy together. One, why should I consider whole life insurance when I can get term? Isn't term cheaper? And two, why should I invest or put money into a large life insurance policy when I can put money into, say, the stock market? Don't I get a better return? All that, and we're going to take a look at an example that illustrates the best policy designs for you and your situation. So let's get started. Okay, so before we make a decision which one to use over the other, let's look at the pros and cons of each and get a good summary of which plan would benefit for certain situations. Okay, so let's start off with term insurance first. So what is term insurance? Well, term insurance is a temporary form of life insurance. Under a contract period or a term length from 5 years all the way to 30 years, we have a locked-in lump sum death benefit that may be awarded in the event of a death. That lump sum death benefit is tax-free and it's given to our beneficiaries at the time of death, right? Okay, so why would we consider a term life insurance policy? Like, what are the pros of this? Well, for one, the cost of insurance is relatively cheap, right? This is inexpensive. We can get a lot of coverage per premium dollar, okay? What else? Payments are locked in for the set period of time. Okay, so if you're doing a monthly payment or an annual payment, your payment premium is the same throughout, so it's not increasing on you as time goes on. Okay. Also, these policies can have living benefits. So what are living benefits? Well, living benefits are what are called accelerated death benefits, or the accelerated death benefit rider that's attached to the policy. So these are for critical, chronic, or terminal illness. Okay, so think cancer, heart attack, stroke, or the chronic illness rider, think disability, unable to work, can't perform 2 of the major 6 daily functions. And for the terminal illness rider, if you have a year or less to live. With that rider attached, just with a doctor's note, we can get the death benefits sent to us, the insured, while we're alive to help manage that health hardship and help pay for either medical bills or just basic costs of living. Now, this is pretty important. Most term policies out there, especially the super cheap ones that some of these financial gurus espouse on, they don't have living benefits. This is kind of a problem because we don't know what the future is going to bring. So if we undergo some kind of catastrophe, we get in a car accident, we get cancer or something like that, we can't work, well, we still have bills. We still have medical bills. We still have to pay for living expenses. And if we don't pass away from it, but we're under the burden of it, having some form of insurance to help pay that out to us, to help pay out the death benefit to us, is a huge help, okay? So keep that in mind. When you're looking at term policies, make sure they have living benefits. Okay, so we talked about the pros. What are the cons of term life insurance? Well, for one, it doesn't have a cash value account, okay? The cash value account allows us to pull money from the policy, build wealth over time. Term policies don't have that, so that's a pretty big negative in the long scheme of things. Also, it tends to run out, the term policy tends to run out before a claim is likely to be made. When it comes to term policies, maybe only 2% of the policies out there actually involve a death claim, statistically speaking. So insurance companies don't mind handing out large death benefit amounts per premium dollar because the likelihood of a payout is super small. Okay. What else is a negative of term life insurance? Well, one of the biggest negatives that I run into daily dealing with clients is the opportunity cost of term life insurance versus securing some kind of permanent form of life insurance. So what that means is some people, they'll get a large term policy in their 20s and early 30s or something of that nature. And when the policy begins to run out in the last few years, they decide, oh wait, I still want life insurance. This policy is going to run out, so let me reapply for new life insurance. Well, the major issue with that is that now that they're much older, in their 50s and 60s, applying for even a somewhat comparable level of life insurance is much more expensive. Not only that, they may not even be able to medically qualify for term policies anymore, leaving them kind of at a loss. They basically missed the boat, so to say, from being able to get lower cost and permanent insurance because they put all their eggs in that term basket. Okay, so all in all, when we look at term policy, what's the best use of term life insurance? Well, it's best for younger people, especially in the more formative years of career development, asset accumulation, and when future potential earnings are significant, we need a large amount of death benefit to cover in the event that life would be to cut short. Okay, I do want to take some time here, a little small detour, and talk about some of the employer group term policies out there. These aren't the greatest, okay, and for a number of reasons. So one of the biggest reasons is that if you were to lose your job, quit your job, move on anytime, or retire, anytime you leave your job, your policy leaves with it, okay? The major thing is that the employer owns the policy, so they can choose what to do with it. And if you leave your job for whatever reason, you lose your policy. And considering that most people tend to spend maybe 5 years on average at a particular job and then move on to the next opportunity, they lose their insurance with it. And then they have to reapply for a new level of insurance, which is likely going to be more expensive because now they are 5 or 7 years older, okay? What else is kind of a negative about these policies? Well, obviously there's no cash value account. You don't own it, your employer does. There are no living benefits, so that's another issue, right? We've probably seen these circumstances before where an individual is going through, God forbid, going through cancer and something like that, and they've used all their sick days, used all their vacation days, and they have to come into work while they're going through treatments, right? They don't have living benefits to cover in that situation. And unfortunately, I've seen it, and I know others have seen it. You know, these people that are going through quite a bit, going through, say, cancer treatment, and are just kind of going through the motions, hoping that they don't lose their benefits just to hold on to them because the employer controls them and they can't take time off from work. Okay, this is a major drag. This is why having your own policy with living benefits is so important. Okay, what is another negative? Well, usually it's a low death benefit amount, especially if your employer is paying for it. Okay, especially if your employer pays the entire premium amount. You know, we've seen death benefit amounts like $60,000. This is not an adequate amount. Okay, especially if you're a little bit younger. You know, in the event of a death, you need to have enough death benefit to cover the future potential earnings. And I'm sorry, $60,000 is not going to cover it. Okay, for any age, in my opinion. Okay, so just consider group policies. Just consider it supplemental, which is nothing wrong with that, but it doesn't replace your own plan, your own policy. Okay, so now that we've talked about term life insurance, let's talk about whole life insurance. First, what is it? Well, whole life insurance is the original permanent form of life insurance. So it lasts our whole life, whether we have a short pay-in period or whether we pay every month or every year. We have a guaranteed death benefit amount that will be awarded to our beneficiaries. Not only that, we have a cash value account that is associated with every type of whole life policy that we can utilize while we're alive. Okay, so what are the major pros of whole life insurance? Well, for one, it guarantees a tax-free inheritance to your beneficiaries whenever you pass away. Now, this is something that a lot of these financial gurus can't seem to understand. This tax-free inheritance, for a lot of people, at least in my experience, is one of the only things that some people even leave behind to their beneficiaries. And if you refuse to get any kind of permanent life insurance, a lot of times the beneficiaries or the children or grandchildren, whoever they are left with nothing at the passing, right? I mean, we've heard kind of the slogans out there, hey, just invest all your money, get a little bit of term insurance, everything's going to be okay. Also, my inheritance, it'll just be my single family home and I'll pass it along to my kids and they can do whatever they want with it. Well, the reality most often, unfortunately, is that the individual loses their life insurance because the term policy runs out. Their investments, usually relying on their 401k, we've talked about in previous videos, their investments aren't enough to carry them through retirement, unfortunately. And during that time period, oftentimes they refinance their house 1 or 2 times. By the end of everything, they leave nothing for the next generation other than an over-leveraged house and probate costs. Without that life insurance in place, really there's nothing left for the next generation. And honestly, in my humble opinion, it's kind of like a birthright. And these financial gurus out there dissuading people from being able to provide for the next generation and give them the next level up through a tax-free death benefit, I think is very unfortunate, okay, and pretty terrible if you ask me. That's me getting off my soapbox for now, but I just want you to consider that. Okay, so what else is a pro of whole life insurance? Okay, now one of the major pros is that it has a guaranteed interest rate per year as that policy goes on and endows at endowment period later in life. Okay. Not only that, if we go with a mutual life insurance company or carrier, we have access to a non-guaranteed dividend that is paid out on an annual basis. Okay, this non-guaranteed dividend is quite useful because it's basically the profit from the life insurance company shared with the policyholders, who, if you want to think about it, are co-owners with the life insurance company. Okay. This non-guaranteed dividend can be used in a variety of ways. One way is you can have it pay down the required premium payments on an annual basis till you have nothing, until you don't have to pay for premium anymore. Okay, it lowers your premium payments. You can use it for paid up additions, which increases your cash value and your death benefit, which we'll get into a little later. And you can just have them send you a check at the end of the year of the profits that are shared with you, okay? So this is a nice benefit, right? This is kind of like a cash flowing asset. That is what whole life insurance is. Okay, so what else? The cash value account has a 0% floor, which means it doesn't really matter how profitable the insurance company is, your cash value account can't lose money based on the actions of the life insurance carrier. Okay, so we have that floor of 0%. Okay, we can only increase based on their action. Okay, based on what the dividend is. Okay, that's pretty important, right? Life insurance is not technically an investment because there's zero risk on the income that comes in the form of dividends. Okay, all right. What else? Well, this cash value account may be used as a line of credit and or can be used on the asset column of your balance sheet. I don't know if you've ever applied for a loan to acquire a rental property. One of the sections in there will say cash value life insurance. It's considered cash, okay? And it can be very useful. And one of the primary uses of what I call the foundational asset, where we grow tax-free, uninterrupted compound interest. We'll get into that a little bit short here. All right, what else? Premium payments are locked in for life. If you put a whole life policy together when you're 25 for X amount of money, that premium payment at 25 is going to be the same at age 80, okay? It's not going to go up on you, okay? So it behooves you to consider getting permanent life insurance and at the youngest age possible so you can lock in that good rate and build wealth over time, okay? Not only that, it has living benefits, okay? So same thing that we talked about, if we get sick, if we can't work, our policy will pay out to us while we're alive, okay? Very important. Okay, so what are the cons of whole life insurance? Okay, well, for one, it's more expensive per premium dollar compared to term insurance. And this does make sense, right? With a term policy, as we stated earlier, the insurance company is banking on the fact that they won't have to make that payout most of the time, right? Only 2% have a claim rate, generally speaking. While a whole life policy, they are guaranteeing that they will most likely have to pay out that large lump sum amount to the beneficiaries. So the premium payment does have to be larger to compensate for that. Also, we're building cash value and all these other nice things, so the premium payment is more substantial, okay? So what else? Like term, one must be relatively healthy to acquire it, okay? There are different types of whole life policies out there that don't have dividends, things like that, for people that may not be in the best health situations. But all in all, in order to get term insurance, in order to get whole life insurance, you do have to be relatively healthy, not have a whole lot of felonies or issues on your record, things like that, okay? What else is a con of whole life insurance? Well, the interest rate or the rate of return or just how the policy grows is modest. When I say the policy, I mean the cash value account, is modest compared to other investments, okay? We may see a gross dividend of about 5% if we utilize the paid up additions rider. We may see a return from 3.5% to maybe 4.5% per year, depending on a variety of circumstances. Compared to, say, stock investing or other things like that, it's fairly modest in its returns. But that said, and in a moment, we're going to see that that doesn't really matter. Okay. So moving on here, let's consider the two questions that we asked earlier in the video, now that we've gone through the pros and cons of each. Okay, so what are the two questions? The first question is, should I get term insurance over whole life insurance? Isn't term cheaper? Okay, so to answer that question, first we'll do a little drum roll here. What is the answer? Well, you can do both, right? We can structure a policy that has a whole life policy with what's called a term rider, okay? And we can go like 10 to 1 on this, right? So let's say we get a okay size of whole life, right? Let's say $100,000 of whole life, and we can do $900,000 to $1 million term rider attached to our policy, okay? So we can have the most amount of death benefit when it matters most during our more formative years, and we still have that whole life policy that's growing compound interest inside the cash value account, and also having that inheritance for later in life for our beneficiaries. We're able to have our cake and eat it too, right? This is quite important, as you can see. So we don't have to choose one or the other, like these gurus are always making it out to seem. We can just have one big policy, you know, where we have a modest amount or however much permanent insurance we want, and we just fill in the gap with term insurance. Problem solved, okay? Now, this leads us to the next question, okay? Question number 2, why should I put money or invest or contribute to a larger life insurance policy when I can put it into an investment, like a stock investment or something of that nature? Don't I get a better return in the market over a large enough time period? And the answer to that question is, you can also do both on that too, right? We can utilize our policy to acquire assets along the way, okay? we can utilize the cash value account, borrow against it, and then go put it into whatever investment or whatever opportunity we're looking into in our journey of acquiring wealth, during our wealth accumulation journey, right? And we're going to see an example here in just a moment. So now we're going to examine an example, a case study of one of our clients, and we'll look at how we can put a policy together that not only accomplishes kind of the hybrid approach we just talked about, but also how he can use it to acquire assets and build his portfolio as well and his wealth over time. Okay, so we're going to be looking at our client here. His name is John. John's a working professional. He has a home and a family, and he's looking to acquire life insurance. But not only that, he'd like his life insurance to be a little bit more useful than just a simple term policy or simple whole life policy. Okay, so John elects to put together a policy of $100,000 whole life policy, $100,000 permanent coverage, and he also wants something to cover the mortgage. And he knows that if you were to just get whole life, the policy, the premium cost would be a little bit more expensive than he'd like. So he elects to put together a 20-year term policy of $300,000. Okay, in this case, John had a $290,000 mortgage on his home. He already paid 10 years into it, so he had about 20 years left. So the $300,000 term policy was an obvious choice there. Okay, so not only that, John elected to put together what's called a paid-up additions rider attachment to his policy. So we kind of hinted at what paid-up additions were when we were talking about the dividend section for the pros of whole life. But to give you kind of an idea here, paid-up additions is basically 1 full year of fully paid-up life insurance. It has a corresponding death benefit amount and has a corresponding cash value amount. Okay, so for every dollar we put into paid up additions, whether it's through a dividend or through a premium payment, that dollar is translated into a certain amount of death benefit and a certain amount of corresponding cash value that gets added to the policy. Okay, so to kind of paint the picture here as far as accumulating more cash value and at a faster rate, we want to be putting in paid up additions into our policy, all things considered. So our cash value account is going to grow by 3 major contributions, right? One is the guaranteed interest that's associated with the standard whole life policy. 2, the dividend that is received from the whole life policy on an annual basis that goes towards, say, paid up additions, rider, okay? And then 3 is paid up additions that are received from the normal monthly premium payments, okay? So in this case, John is maximizing his cash value accumulation by utilizing all 3 types here to grow his cash value as quickly as possible. That said, John wants to have a manageable payment, so the cost of the whole life plus the term plus an additional amount for paid up additions, the 3 of those added up come out to about $200 a month in his policy. Okay, the paid up additions is a little over $50 a month when we put this together for John. That said, that $50 a month is going to balloon quite nicely for him over time. Okay, so let's take a look at an example of a policy combination that we can put together and how we can acquire these assets, right? So in our example here, we're going to be looking at a stock investment, okay? So John is a stock investor, a stock market investor. He's been doing it for a number of years, and he lays eyes on a security that he fancies quite a lot. This one is called AbbVie, okay? So this is a pharmaceutical company. So we're going to be utilizing a tool that I've been using for years, and hopefully you can see value in this as well. It's called Fastgraphs. Well, what's nice about Fastgraphs is that we can kind of more accurately time whether a security is overvalued or undervalued. Looking at the chart here, we're looking at the price action or performance of this stock in question, which is AbbVie, ticker symbol ABBV. So for the sake of demonstration, we're going to be assuming we're all the way back in the end of 2018, beginning of 2019. Okay, and we're looking at this stock, the action of this stock during that time period. What's nice about this tool, Fastgraphs, is that we can see historical performance, forecasting, analyst scorecard. Okay, so kind of see how the analysts have kind of forecasted future growth or future performance of the investment. We can see with the black line here how the security has done over time, whether it's considered overvalued by seeing if the black line here or the price action is higher than, say, the PE ratio. And if the black line is below, then it is likely undervalued, okay? And we can use this as indicators on when to buy or sell, okay? I've been using this for years. I've always found value on it. It's something I wanted to share with you all. And you know, investing is hard enough. So if you find value in this, there's a link in the description, a affiliate link. Go ahead, click on it. If you find value in it, go ahead and sign up. All right, so in this case, we see that in late 2018, we have AbbVie is undervalued, okay, according to the Fastgraphs here. So we see that AbbVie is kind of floating around $90 a share. So John, who has been a stock market investor for all these years, looking into this security and would like to invest in this stock. Now he has his other funds are tied up in other investments, so he peers into his cash value life insurance policy for additional funds. Okay, so when we look in years down the road, his cash value account has accrued to $30,438. Okay, so what's nice about this is that's accessible, that we can access and use for whatever purposes we see fit. We don't have to reapply or ask for permission. That's our money and we can use it as we see fit. So in this case, John elects to use a policy loan. So he calls up the life insurance company and says, hey, I would like, of the $30,000 plus in my cash value account, I would like you to advance me $25,000 as a policy loan to me. Insurance company says, great, we'll wire it on over. We get $25,000 from our cash value life insurance policy, wired over to our account, and we can use it as we see fit. Okay, so John elects to transfer the $25,000 into his brokerage account, and he buys the stock at a share price of $89.07 per share on January 4th, 2019. John, in this case, has invested $25,000 into AbbVie. We also set up the trade, because AbbVie does receive an annual dividend, we set up the trade, or a quarterly dividend, I should say, to reinvest the dividends into the stock. Okay, so we're going to buy more shares as time goes on. Not only that, we're getting paid over the long period to hold through that dividend, so we don't mind holding that long. Okay, so we invest $25,000 and we utilize the policy loan from the insurance carrier. Now, what's nice about borrowing from your life insurance policy as opposed to, say, borrowing from like your home equity through a refinance or something of that nature is that the insurance company can give us a much better interest rate. Okay, so this insurance carrier that we're using gives us a 4.5% interest rate on our money to the borrowing costs. I don't know if you've looked, this is the year 2024, I don't know if you've looked recently, but a home equity loan at similar numbers, I've seen 10+%, okay, to borrow that kind of money. Not only that, because it's a life insurance product and because the death benefit is essentially the collateral for the loan, the insurance company does not require us to immediately start making payments of principal and interest towards that loan, like we have to in some kind of home equity loan. okay? So we're able to borrow the money, and any interest that's accumulated, we can just roll that over and pay it back later. And in this case, that's exactly what John does, okay? So 5 years later, looking into the future, okay, when we look at our stock, what do we see? Okay, 5 years later, the stock, AbbVie, has appreciated to $162.14 per share. So now we have a total value of our holdings here of $52,739.42 when we go to sell. So now that we have acquired all this additional wealth through our stock investment, we can now pay back our original loan of the $25,000 plus that rolled over interest, which totals, in this case, $31,155, okay? Because our policy, this is important, this is why I call it the foundational asset, right? Because our policy grew tax-free, uninterrupted compound interest, when we pay it back, we don't realize any opportunity cost from borrowing against our policy. The policy continued to appreciate in the same manner as if we never pulled the funds out at all. So our policy new cash value after we pay back our loan plus the interest is now not $30,000, now it's $51,589, okay? And when we look at our stock portfolio and our brokerage account after we paid it back, we also see that we have a profit of $21,624.42 over that 5-year period, okay? So this is kind of nice because if we look at this, our policy on one end, the cash value, grew from 30,000, roughly 30,000, all the way to 51.5, okay, 51,500 some odd dollars. Meanwhile, we pocketed 21,500 some odd dollars from the profit on our stock trade, on our long-term stock trade with the stock AbbVie, okay? So we made 21,500 or so in our cash value account. We made another 21,000 or so in our profits from our stock investing. So we split our dollar and we doubled our money, okay? Just by utilizing this concept that's commonly known as the infinite banking concept, but we utilize this in just a basic life insurance policy. So you don't have to necessarily have some, big specialized infinite banking type policy. We can utilize this in just a simple whole life policy, okay? So not only that, but I do want to bring your attention to later in life, okay? When John is set to retire and he's looking at his policy over the years and he's looking at its performance, and when he looks down at it, he's going to see, let's say at age 75 years old, he's going to see a cash value account that's accrued to $169,739 with a corresponding death benefit of $271,534, okay? Why did it grow that much? Well, those were all those paid up additions that we paid monthly into the policy, along with the dividend, along with that guaranteed interest rate. Our cash value has grown substantially, okay, to approximately $170,000. What's nice about this is that we can borrow against that $170,000. We can borrow up to usually around 95% and pay ourselves in retirement, give ourselves a tax-free check in retirement, whether we want kind of smaller checks on a monthly basis or just take out a big bunch of it. We still have this large $100,000 difference between the cash value and the death benefit amount. So we could pull out basically all our cash value and still have a death benefit of roughly $100,000 to give to our beneficiaries if we choose. Or we don't have to pull it out at all and give them close to $270,000 plus in retirement, okay? So you can kind of see how we accomplish many different things at once, right? In summary, what do? We have our whole life policy, which is that $100,000 whole life policy, right, that we're going to give to our beneficiaries. We have that term rider we put together when we needed it most. We had that mortgage and we wanted to cover that in that extent. We borrowed against our policy to fund other investment opportunities. And in our example, we used AbbVie, okay? And not only that, later in retirement, our policy continued to grow so that we could borrow against it to give ourselves a tax-free income in retirement, right? Tax-free, remember, it's tax-free because we utilize a policy loan. Unlike, say, our 401k, which gets taxed and is open to market risk, we have this asset class that we can dip into whenever we need, okay? And we have those living benefits along the way. So we've accomplished a lot with one simple policy, one decision made at roughly the age of 35 years old, and we can see how this has benefited us over the long run. This is why I call this the foundational asset, right? We're able to not only protect ourselves and our family, but also grow our wealth and secure our futures through the life insurance policy. Thank you for watching our video here on the differences between term life insurance and whole life and how you should consider putting a policy together to kind of match your needs and your wealth building goals. And we saw in today's video that we can have our cake and eat it too. We can have a whole life policy with a term rider, and through the use of paid up additions, we can grow our wealth and acquire assets and fund our retirement along the way, right? So next time a financial guru out there on the internet tells you one or the other, just remind them that you know the game and you know that a policy can be put together to maximize not only your protection needs, but also your ability to acquire wealth over time, okay? So if you are interested in putting a policy together to kind of serve your own needs, something similar to what we've talked about today, just click on the link in the description. We'll take you to our website, mylifeinsurancebroker.net. Be a short form there just for your basic contact information and for you to tell us what kind of policy you want to be put together in the first place. Filling that out, it'll take you to a booking page where you can enter in your information and we can set up a free consultation call, okay? As with all of our consultation calls, we go over your financial circumstances, your goals, and how best to approach them, okay? Thank you for watching our video. If you're interested in this kind of content, feel free to click like and subscribe to the video, and I hope to see you along our wealth accumulation, wealth building journey. Until next time.